Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Riot platforms.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick reminder, the VIP Algos link is right below in the description.
Definitely check that out.
So to kick things off today, normally business math is pretty straightforward, right?
Right, usually.
You make a widget for $1, you sell it for $2, and your stock goes up. But today, looking at Riot platforms, that logic just completely fractures.
It really does.
Because if you look at their current balance sheet, they are running at a staggering, negative 132% net margin.
Which sounds terrifying.
Exactly. They're just hemorrhaging cash on paper, yet the stock is up almost 70% year to date. And Wall Street is actually upgrading their price targets.
Yeah, which makes zero sense if you're only looking at the daily price of Bitcoin.
Right. How does a financial treadmill get rewarded like that?
Well, viewing this purely as a crypto play completely misses the actual mechanics of the business. You know, the reality of Riot platforms is it's really a story about building massive energy infrastructure.
Okay, infrastructure.
Yeah, and surviving this brutal war of attrition. Plus, there's a completely unexpected technological pivot on the horizon that could just, redefine their entire valuation.
Okay, let's start with that initial profitability paradox, because the numbers are, they're jarring.
Very.
On the surface, the core operation is growing. Their trailing 12-month revenue is up over 42%. And they have a gross margin of 32.35%.
Right, so the physical act of mining the Bitcoin is viable.
Exactly. But when you slide down to the bottom line, they're reporting an earnings per share of negative $2.58.
Yeah.
Wait, if I'm looking at this as an investor, how does a company lose over $2.50 per share, burn cash to build these huge Texas facilities, and still get a buy rating from analysts?
It really comes down to separating cash flow from accounting losses. Specifically, how we view capital expenditure, or CapEx.
Okay, unpack that a bit.
Sure. So when institutional analysts look at Riot, they don't see a structurally failing business. They see a company absorbing immense short-term accounting pain to build long-term infrastructure.
So the negative EPS is mostly, what? Depreciation?
Exactly.
Yeah.
That massive negative earnings per share is heavily driven by depreciation. They just bought and installed thousands of these highly expensive specialized computing rigs across their Texas sites, like their massive new Corsicana facility.
Oh, right.
And in accounting terms, the value of that hardware drops rapidly over time. So that drags down the net margin on paper, even if the company isn't actually writing a new check for that amount every single month.
I see. So the infrastructure is essentially dragging down the spreadsheet, but the physical assets are plugged in and working. But even if we discount the depreciation, expanding at this scale requires just a mountain of capital. And here's where I want to look at how they are funding this, because the contrast is wild.
Oh, you mean compared to Hut 8?
Exactly. If you compare Riot to a competitor like Hut 8, the financial strategy is completely different. Hut 8 recently had to price over $3 billion in debt.
Yeah, at a rate of 6.192%.
Right. To fund their own expansion. In a market as volatile as crypto, taking on billions in fixed interest debt just to keep the lights on, that seems incredibly dangerous.
It is a massive premium to pay for capital, and, it creates a highly fragile operational structure.
Because the debt payments never care what Bitcoin is doing.
Exactly. If the price of Bitcoin drops significantly, that fixed debt payment doesn't change. You are forced to service a 6% loan on $3 billion while your main revenue is plummeting.
Wow.
Riot is taking a drastically different path. They're funding their expansion primarily through their own operating cash flow and by raising equity, so issuing shares.
Which, that dilutes existing shareholders a bit.
It does.
But it completely avoids that toxic debt trap.
Exactly. They are keeping their debt burden remarkably low. And if you look at how the market values them, their price-to-book ratio is sitting right around 3.69.
So just under 4 times the worth of their physical assets.
Right. The land, the buildings, the transformers. That shows solid market optimism about their future growth. But it isn't completely divorced from reality. It's built on a sturdy balance sheet, not speculative leverage.
So if they aren't relying on massive Wall Street loans to build these sites, they must be getting an incredible return on the infrastructure itself, Which brings up the location.
Texas.
Yeah, they are pouring hundreds of millions of dollars into Texas dirt. What makes that specific grid so valuable for them?
So the competitive moat they've built down there goes way beyond just housing computers. They have engineered a vertically integrated footprint that's secured by long-term power purchase agreements. Right. These agreements lock in the price they pay for electricity well into the future, which shields them from the wild spot power prices that normally crush smaller operations.
Okay, but it gets better with the grid operator, right?
Oh, the ERCOT demand response programs? Yeah, this is the true ingenuity of the Texas location.
Because grid operators monitor the flow of electricity.
Yeah.
And since Bitcoin mining draws an unbelievable amount of continuous power, you'd think the grid operators would hate them. Like, view them as a massive liability.
You would think so, but it actually functions in reverse.
Really?
Yeah, because of the nature of the machinery. Look, a data center running cloud services for a hospital or a bank, they cannot just turn off.
Right, that would be a disaster.
But a Bitcoin mining facility can throttle down its power consumption to absolute zero in a matter of minutes. So when the Texas grid is under severe stress, like during a huge summer heat wave, the grid operator will actually pay Riot to shut their machines off.
Wait, they pay them to stop working?
Exactly. They earn these power curtailment credits by powering down and returning that allocated power to the public grid.
So it's like pre-buying all your gas for the year at a steep discount, and then when gas prices spike during a shortage, you just sell it back to the grid for a profit instead of driving your car.
That is the perfect analogy. It's energy arbitrage. They've built this dual revenue stream. On a standard Tuesday, they use cheap power to mine Bitcoin. On a day of extreme grid stress, they power down and earn millions in credits.
That's brilliant. It completely flips the narrative. They're an industrial shock absorber for the local energy market.
They literally get paid a premium to not mine Bitcoin when electricity is most expensive.
But even with that ironclad setup in Texas, Riot is still tethered to the broader macro environment. I mean, the stock is notoriously volatile. I saw they have a beta of like 3.87.
Yeah, almost a 4. And a beta that high means the stock is hyper-reactive to broader market movements.
Right, so if the market twitches, Riot jumps.
Exactly. If the S&P 500 moves up 1%, a stock with a beta of nearly 4 might jump 4%, and it falls just as aggressively on the way down.
And the macro weather has definitely been shifting lately. We just saw weaker June inflation data, which got the market pricing in potential Fed rate cuts for September.
Which is huge for risk-on assets.
So walk me through that. How does a September Fed rate cut physically boost a Bitcoin miner in Texas?
It's all about currency valuation. When the Federal Reserve cuts interest rates, the yield on holding U.S. dollars or Treasury bonds decreases.
Okay.
This generally weakens the dollar. And historically, a weaker dollar is a massive tailwind for risk-on assets like Bitcoin. Investors move capital out of fiat currency and into assets not tied to central bank policy.
Right, so cheaper money leads to higher crypto prices.
Exactly, which directly inflates the value of the Bitcoin Riot holds on its balance sheet and pumps up the margin on every new coin they mine.
There's another major catalyst floating around Washington right now, too. Former President Trump has been loudly pushing for the Clarity Act.
Yeah.
And just to be clear, we are looking at this impartially. We're just reporting what the market is pricing in here, not endorsing the politics of it.
Of course. Strictly looking at the market mechanics.
Right. So this legislative effort aims to tie U.S. crypto regulation directly to the U.S.-China AI race. The argument being that over-regulating crypto in the U.S. pushes innovation and capital overseas.
Right.
So my question is, does a potential Senate vote on this in Q3 actually change the math for Riot? Or is it just political theater?
Oh, it fundamentally changes the math.
Really? How so?
Because of institutional capital. Right now, regulatory ambiguity is a frozen pipeline. You have pension funds, sovereign wealth funds, major university endowments. They're sitting on trillions of dollars.
Just waiting on the sidelines.
Exactly. Because of strict fiduciary duties, they cannot pour billions into an industry the SEC might declare illegal next year.
The compliance risk is just too high.
Yes. But if legislation like the Clarity Act passes, it provides explicit legal definitions. Once institutions have a clear rulebook, that pipeline thaws.
So they can finally deploy capital into infrastructure providers like Riot.
Exactly. A Q3 vote removes a massive structural barrier.
Okay, so that paints a very optimistic picture. The Texas energy arbitrage, potential rate cuts, thawing institutional capital. But we have to look at the downside, the risks.
Yeah, the bear case is very real here.
Because there is a glaring red flag. Despite Bitcoin recovering, the mining equities, like the actual stocks of these companies, are down roughly 45% on average over the past year.
Yeah, that divergence is the biggest friction point in the industry right now,
Yeah.
and it stems from severe margin compression.
Right, the mining difficulty trap. The Bitcoin network operates on this self-correcting algorithm, right? It releases a new block every 10 minutes or so.
Exactly.
And to keep that schedule, the network constantly checks how many computers are plugged in. When Riot and everyone else plugs in thousands of new machines, the network just makes the math puzzle harder to solve.
It ensures the supply issuance remains perfectly fixed, no matter how much hardware you throw at it.
But wait, isn't that essentially a built-in death spiral? You spend $1 billion on faster computers, your competitors do the same, and the network immediately punishes all of you by making it harder to earn the same amount of Bitcoin.
It is a relentless, capital-intensive grind.
If the price of Bitcoin stalls, you're just burning cash on a treadmill that speeds up forever.
Yeah.
And we're seeing insiders selling at Riot too, right? Like negative 421,984 shares over the last 90 days.
Yeah, the execution risk is high. The insider selling might just be executives taking profit after a 70% year-to-date run, but it absolutely highlights the reality of the cash burn.
It's a real concern.
But this is exactly why Riot's strategy of massive scale and avoiding toxic debt is their primary survival mechanism.
How does scale protect them if everyone is on the same treadmill?
Because it becomes a game of attrition. When difficulty spikes and margins shrink, the pain isn't equal. Smaller miners without locked-in power or miners suffocating under 6% interest on billions in debt, they bleed cash rapidly.
So they eventually just have to shut down.
Right, they go bankrupt and unplug their machines.
And when they unplug, the global computing power drops and the network automatically lowers the difficulty level again.
Exactly that. It's a brutal consolidation cycle. The market share naturally vacuums up to the well-capitalized giants like Riot. They're designed to absorb the damage long enough to watch competitors die off.
Wow. They just outlast the winter by having more insulation. But this dynamic, building these massive computing fortresses with dedicated power, leads us to the most speculative plot twist here.
Oh, this is the most fascinating part of their whole model.
Because surviving the crypto winter leaves Riot holding an asset that might be way more valuable than the Bitcoin they mine. We are talking about high-performance computing and AI infrastructure.
Right. The AI hyperscalers are facing a massive physical bottleneck right now. It's not a lack of microchips. It is a desperate lack of physical electricity.
AI models just require an unimaginable amount of continuous power and cooling systems.
Yes, and building a new AI data center from the ground up takes years. Permitting, substations, grid access. The tech giants do not have 4 years to wait.
Which puts a huge spotlight on Bitcoin miners. I mean, we just saw Applied Digital lease out a massive 430 megawatt facility to a U.S. hyperscaler for AI.
Exactly. And now the speculative focus is locked entirely on Riot's massive Corsicana site.
Because it has the exact power infrastructure to attract a major AI retrofit.
It's incredibly compelling. Think about what they've built.
It's like spending a decade building a factory for a single product, and when margins get tight, you realize you can just rent out the floor space to the hottest tech companies on Earth for guaranteed cash.
That's their speculative ace in the hole. Now, to be clear, there are no official announcements from Riot regarding AI leases yet. It's completely unconfirmed.
But the market is watching their Q2 earnings like a hawk.
Oh, absolutely. Even a hint of an AI compute lease would fundamentally re-rate the stock. It divorces them from Bitcoin's volatility and turns them into a foundational AI real estate play.
Okay, so synthesizing all of this, what's our final verdict? Looking at both the upside and downside, the bullish score here is sitting at a solid 7 out of 10.
Yeah, 7 out of 10 feels right.
Because, yes, the negative margins are brutal, and the difficulty treadmill is a constant risk. But Riot's unparalleled scale, their Texas energy moat, and their lack of toxic debt make them a designated survivor for the long term.
They've built a corporate fortress designed to endure the exact pressures bankrupting their peers.
And it leaves you with this truly provocative thought. What if the ultimate winner of the Bitcoin mining race isn't the company hoarding the most digital coins?
Right.
What if the true winner is the company that accidentally builds the most valuable energy arbitrage and AI computing real estate of the 21st century?
It's a phenomenal thing to consider for the long-term view.
It really is. Well, if you find our talks useful, please consider subscribe, like, and comment underneath. And one last reminder, check out the VIP Algos link below in the description. Thanks for tuning in, and we'll see you next time.